Hey, we're live. This is Matthew Newsom, I'm the attorney with Surge Business Law, and this is May Ask Me Anything. And we have a bunch of questions related to growing your business successfully. So thank you for all the people who asked questions to make it to the list. If you would like to ask a question, please do so. You can go to YouTube, Facebook, LinkedIn, and you can find our form where you can ask questions. Drop me a note any way that you like. You can be anonymous, and you'll see that some of the questions today are anonymous, or you can share your name. And some of the questions today, people wanted to be mentioned. Before we begin, let me just remind you to hit the subscribe button so that you can see when we do other announcements. For example, in 1 week, we will be doing a webinar, another live stream related to changes to the 1099 versus W-2 discussion so that you know when you're hiring an employee, should you classify them as a contractor or as a W-2 employee. So if you are interested in that topic, and you should be because the rules have changed in March of 2024, then you're going to want to join that webinar, which you can find on all of our social feeds. You can find a link to it. Let's go ahead and jump into our presentation. Can I put my business into an IRA? This question came in this morning, and the answer is yes, you can, but you probably don't want to. There's a thing in the USA called a self-directed IRA. A self-directed IRA is just what it sounds like. It is an IRA. It is a tax shelter where you can invest money and watch it grow. A self-directed means that you can invest in anything that you want. For example, you can invest in real estate. You can buy a rental house or an apartment building in your IRA, and then the money that makes will stay in your IRA and grow in that tax protected status. You can also invest in businesses with your IRA when you do it like this. But this question doesn't say, can I invest in businesses? This question says, can I put my business into an IRA? Self-directed IRAs can be abused, and so in order to make that unlikely or less likely, then the federal government puts very, very strict rules. If you break the rules, the tax consequences are not fun. And so a couple things you have to do is, first of all, you and the people close to you can't really benefit from that business. And so if it's a business that you run or that you work in or that you take profits from or that you get payroll from, or if your kids or your spouse or other family members do, then you should not put them into the self-directed IRA. But I want you to know that there is such a thing. And so you should and you can look into the self-directed IRA. Before you pull the trigger, you need to talk to a financial advisor or a tax attorney, and I am neither. But talk to them so that you can make sure to do it right, because it is a very cool and powerful tool available to you. When and how should a SaaS company expand outside of the USA? Josh Larson, the founder of BarkPass, asked this question. I rephrased it a little bit to make it more general. Please bring me more questions like this. I really love answering questions for SaaS entrepreneurs and fintech and ag tech and other types of entrepreneurs. Love to answer more of your questions. And if you have a question and you're watching this, feel free to drop it in the comments. I will get your question, but I will put it in the next video that I do. But how and when should a SaaS company expand outside of the USA? And there is another version of this. How should you expand into the USA? If you want to know the answer to that one, make sure to mention it, and I will do that in the next video. First of all, international business can be quite challenging. And so it is pretty easy to simply put a sign-up form on your website that does let you get customers in other countries. But I want to just highlight a couple of the risks that you can face. First of all, the laws are different in different countries. That should go without saying. So if you expand into Canada, you might find a couple things that are different. For example, LLCs might not work quite the same way. Corporations might not work the same way. Taxes probably don't work the same way. Canada is an example of a relatively low risk country to expand into if you're in the US, because our legal system is founded on many of the same principles. The UK and Australia are also similar in that their legal systems are very much like ours. However, you will probably find that these countries differ in some pretty interesting ways. And so what you should do is you should talk to somebody in the country if you're going to target it. If you do not want people in those countries to use your business until you've done so, then you should put a limit on it. But I did make a list of things that I think that you should pay attention to. So first of all, the laws are different. And so particularly limited liability laws can vary quite dramatically. So if you have an LLC or a corporation, you probably have that so that you can limit your liability. Make sure not to shoot yourself in the foot by doing something that would change your liability limitation features of your business. You're going to have to deal with currency changes. And so it is possible that you can require people in other countries who use your service to pay in US dollars. However, they will probably not like that. There are some countries, for example, Canada, where it's not that weird, that most people probably have had the opportunity to do that. But if you can accept local currency, then you will get much more traction in that country. And so you're going to want to figure out, how do you accept currency in the local country's bills. And so that brings up exchange rates. And so, maybe it's not weird for US and Canada to be pretty close to 1-to-1, but it is not weird for them to fluctuate. Well, what happens if the US dollar becomes more valuable than the Canadian dollar? Well, that means that now in Canada, your prices either go up to your Canadian clients, or if you charge $10 for your product in the US, $10 in Canada, then now the revenue you're actually getting from Canada is lower because the Canadian dollar at that point might not be worth much. But what happens if it switches? Then, that's another problem you have to deal with. Also, you have to deal with exchange rates. And so that means that you're going to pay to have your currency converted from one currency to another. And that can be a relatively small fee, but 5% is not weird. And if you don't like credit card fees of 3%, which who does, then you're not going to like exchange rate fees of 5%. And by the way, you might have to pay both. And so that would be 8%. You're going to need to factor that into your business. Sales tax can be very different from place to place. Even in the US now, it's different from one city to another, one state to another. When you cross over a national border, it can vary quite differently, quite dramatically. And then we have probably the one that a lot of people that have a technical background think about, but that is privacy laws. And so especially when you jump over to Europe, privacy laws can be very, very different. Many countries in Europe are part of the EU, and the EU has adopted a privacy and cybersecurity law called the GDPR. And that does put quite a bit of burden on businesses, even if they're US businesses that operate over there. You do have to comply with it. And so if this is you, my number one suggestion is that you should contact a US attorney and then let them help you get in touch with an attorney in the area that you are going to. And so as it turns out, Surge Business Law is a fine company to work with, because we do have an attorney on our team who specializes in international law and is licensed in multiple countries besides the US. And so we can help you make a strategy so that when you expand into a new territory, you can do so safely, and so that you can grow in a safe and secure fashion. And so the next few questions in this live stream are going to be talking about pay and profit. And so these are questions that came up in some client meetings. And so I have reworded them. But this is something that's very dear to my heart. Many business owners are not paying themselves, or they're not paying themselves enough. Now, I know when you are a founder, when you are starting your business, it's normal to go a little while with a low or zero pay. The problem is when it gets to be 5 or 6 months or a year or years and you haven't paid yourself, I'm not okay with this. This is not a business. This is probably not even a hobby at this point. This is a problem. And so I want small business owners, even business owners that are doing things like SaaS, where they're focused more on growth and revenue, you need to pay yourself. It's very important. So the next few questions, we're going to talk about that. First, how much should an LLC owner pay themselves? This is a couple of facets to this question. And so if you do nothing else, then all of the profits in the business would be attributable as owner pay. And so let's just say that you've got two owners, 50-50, and their profit is $10,000 a month. That means, as far as the tax authority is concerned, each owner is making $5,000. And so you're going to have to pay tax on that. You might choose to not pay yourself all of that money so that you can build reserves, and that is a smart move. Please do that. But the IRS doesn't care. They're still going to think that you're taxed on that. And so I just want you to know that any profit that comes into the business is going to be considered taxable income for the business owners, proportional to their ownership. But then you've got a situation where the owners, maybe they have another job, and so this is kind of a side gig that's very common. And so how much should you pay yourself? Well, what I like to see is I like to see business owners taking a little bit of the profit, a little bit of the revenue that comes in on every transaction and setting it aside. And I'll just give you an example of what I do with my law firm. 8% of the money that comes into the business right off the top gets set aside and moved immediately into another bank account and is tagged as owner profit. Now, that does not account for all of my pay as the attorney and owner of the business, but I just reserve 8% right off the top, and it gets set aside so it doesn't get spent or used for any other purpose. Please do this, steal this idea. If you haven't read a book, but you'd like to on this topic, Profit First by Mike Michalowicz is an excellent, excellent book. And he makes just a dead simple tutorial on how to do that. And it's very entertaining, especially if you do the audiobook. But what I like to see owners do is pick a percentage, 1%, 5%, 10%, 20%, whatever it is, right off the top of the profits, set it aside, and then use that for owner pay. But ultimately, what I would like to do is I would like to see phase one goal of the business is for the owner to make as much from their own company as they could if they were an employee of someone else. So for example, let's just say that you've got a retail business and you are running it and you've got employees working for you. Phase one is you should make as much as you would pay a manager to step into your shoes. And so if a manager at your retail store would make $25 an hour, that is about $50,000 a year. I'd like to see you making that much. Phase two is I would like to see you making significantly more, because owners are taking on a lot of risk. And one of my main principles in owner pay is that you should profit from taking risks. Kind of like you put money in the stock market to get 20%, which is way better but way riskier than putting it into a savings account and getting 2%, right? We take risks because we want to profit. And so as a business owner, you're on the hook for everything. You should make more money than if you were an employee. But phase one, you should make as much as an employee. Phase two, you should be making significantly more. And that does bring up an interesting point. If your business is ready to go into the scale phase where your business is growing rapidly, that is an excellent time to talk to me, because the scale phase is one of the riskiest areas of business management. And that is the time where my services as a risk management business attorney are most profitable and useful to you. So please call me if you're going into that phase. But there's my two goals. Phase one, make as much as an employee. Phase two, make significantly more than an employee so that you're getting paid commensurate with your risk. That leads us to the next question. How do I pay myself through my business? How do I pay myself through my business? Step one is you pay yourself profits. And so if your business costs $4,000 a month to run, maybe you've got something simple and small, low overhead, and you're making $10,000, then you can just take as much of that profit as you want and write yourself a check or do a bank transfer into your personal account and spend it. I will say that you are going to be subject to self-employment tax. I'm going to get to that in a moment. So you're going to want to set some of that aside for future taxes, but that's how you pay yourself. You just write yourself a check or just do a bank transfer. Please don't take the money out of your account and just use your business debit card as if it's personal money. That's a good way to pierce the corporate veil. We don't want to do that. Transfer it from your business account to your personal account and spend it that way. Step two, if you want to get a little bit more sophisticated in how you do things and your revenue or your income from your business is growing, maybe you're getting $80, $90, $100,000 a year, then it's probably advisable to reclassify your business as an S Corp. This allows you to pay yourself in two ways. You can pay yourself a wage or a salary, just like an employee. Are we live? Are we back? Okay. We had a little internet problem here. Okay. First time that's happened, Wi-Fi flaked out on me. I'm connected through my hotspot. We'll see what happens. Uh, how much should an LLC owner pay themselves? Okay, so we talked about splitting your income into two parts. One would be by paying yourself. The first part is by paying yourself a wage or salary using payroll. That requires you to be an S corp. The second way is then money that's left over on top of that would be distributed to you as a profit. The benefit of this system is that it allows you to pay full normal self-employment tax and other taxes on your wage or salary, which is part of your income. And then the remainder, the profit part of your pay, gets taxed at a preferable rate. So that is an excellent way to do that. What I want you to know, though, is that the part of your income that you pay self-employment tax on is the part that's going to be used to calculate any Social Security benefit that you might get one day. And so if part of your retirement plan is to rely on Social Security, then the part that you pay self-employment tax should probably be higher than you might otherwise do it. And so if you are not paying yourself with a salary or a wage, you're just paying yourself profit, then that's all of your income is going to be subject to self-employment tax and used to calculate your Social Security benefit. If you're splitting your pay half and half, then only half of it will be used. So keep that in mind when you're deciding how much to pay yourself. It is unfortunate that the more tax you pay, the more future benefit you might get. My suggestion is don't pay that much self-employment tax, reduce that, and instead use an IRA or 401k or something like that to save for retirement. How do I pay myself through? How do business partners get paid when only some are active in the business? And so this happens quite often. Let's just say that we've got two partners 50-50. One of them is working day in and day out running the business. The other one is a silent partner. We see this quite often. So that's fine. Absolutely okay. Go ahead and do that. But what we will typically do is we will split the owner's pay in two parts. One will be a salary or payroll. So you would get paid just like an employee. And then the rest would be profit distributions. Now, this is subject to the agreement of the partners. I'll get to that in a second. But if the partners agree, then let's just say that, again, you've got a retail shop and you're paying your employees $18 an hour. Then you might agree to pay the working owner 18, 19, 20, maybe $25 an hour for being in the business, running it like a manager. Then any profit that's left over is split so that the two owners take it 50-50. That is a good way to do that when you want to make sure that the person who is working in the business is compensated. However, we do see a variation of this when the the owners have contributed different amounts to the business. For example, let's say that you've got a business and it cost $100,000 to start the business. The silent partner brought most of the cash. They chipped in, say, $90,000. And then the other partner just brought a little bit of cash or maybe equipment that's worth $10,000. And so now what we have is we have a disparate amount of the capital account for the business. And so the agreement between the partners might be that the one who brought less cash offsets that by working for free so that they take only profit distributions. That's fine. But this does highlight one of the most important things about partnerships, and that is you need to have these conversations at the beginning. This is a good time to call an attorney like myself. You can call Surge Business Law, and we can help you have a conversation with your partners. That way, at the beginning, when everyone's hopeful and optimistic and happy, then we can get this put in writing so that down the road later, if there's ever a dispute, then you will be able to go back to what you decided at the beginning and say, yeah, here's what we said. It's in writing. It's a contract. And you can make that make everyone happy. So for example, using that 90,000 contribution, 10,000 contribution, what we might do is we might say, okay, the employee would have been getting paid, I'm sorry, the employee owner would have been getting paid $20 an hour. And so when they've made enough money that they weren't paid for their wages to offset that $20,000, then they're equals. And so that way, at that point, then the one who's working in the business would get paid probably a salary, and then the owner would get paid. The owners would then get paid the remaining in profits. That can be complicated. It doesn't have to be. If you'd like to know more about this, please leave a comment, and I'm happy to share that with you. Can a business owner reinvest profits into the business? Yes, they can. However, whether or not it's taxable income depends upon how you form the business. And so a lot of business owners form LLCs. If you are a single owner LLC, the IRS basically ignores the LLC and treats you as a sole proprietor. Every dollar that comes into the business appears to go right into the single owner's pocket. And so the IRS ignores LLCs in that sense. If you're a partnership, basically the same. It's treated as a partnership. And so there's a Schedule K that is done, but basically every dollar that comes in appears to go into the partners' pockets proportional to their ownership. And so there is a little tax work in that case, but for the most part, the business cannot retain profits without paying tax on them. If you are an S Corp or a C Corp, you can get a different strategy. You can retain profits that are not distributed, and then you might not have to pay the double tax that corporation owners are subject to. So corporations do have a problem with double taxation, whereas the corporation has to pay tax on their income, and then when the profits are distributed, the owners have to pay taxes on the profits. There are numerous ways to reduce this tax burden so that you don't have to pay tax twice. Please talk to a tax professional about how to do that. But the point is that some business structures, C Corps, for example, can retain profits without the owners having to pay tax on them. And so if you want to reinvest a significant amount of money into the business, for example, if you're getting ready to make a big expense like real estate or equipment, then you might end up having to pay tax on the money even though the owners don't get to spend it. Talk to a tax pro. If you need help with the tax pro, talk to me and I will help you get in touch with the right people, and I'll help you know the right questions to get the conversation on the right foot right away. What is self-employment tax and what should I do or not do about it? Self-employment tax is not actually a certain tax that only applies to self-employed people. Self-employment tax is just the effect that business owners and self-employed people have on their taxes. If you're in the US, if you've ever looked at your pay stub, you've got several things. You've got federal tax, you've got state tax, maybe you have local city or county tax, and then you also have this other group of things called FICA. And FICA is about 7.5% of your pay that gets pulled out to pay for Medicare, Social Security, things like that. What you often don't realize is that when you're employed by someone else, you're only paying half of that FICA. Your employer is matching your FICA tax, and so they're paying half as well. When you're self-employed, you don't have anyone else paying that other half of the tax for you, and so now that FICA part doubles. And so we often call that self-employment tax. Yes, it sucks. It can be quite a surprise. My first year being self-employed, I accidentally underpaid myself or underpaid my taxes by a significant amount. And of course, I waited until like April 10th to do my taxes, and I had to come up with a pretty big amount of money in at the last minute. It was no good. And so don't be surprised by that. But self-employment tax, it's just a reality. You know, you will probably get the benefit from that if you live long enough. Will it be worth it? It's hard to say. Um, so if you want to minimize it, here's what you do. First of all, is you want to be aggressive with your tax write-offs. Talk to a CPA, and there are different types of CPAs. Some CPAs are really cautious and they like to play it safe. Some CPAs are really aggressive, maybe even illegally aggressive at avoiding taxes. And so find someone who has a strategy that aligns with your goals. But ideally, I like to find people who are keeping up on the latest changes in the laws so that they can help you aggressively pursue any tax write-offs. Because by reducing your taxes, you know, that just helps you put more money in your pocket. Second of all, I want you to understand, and I think it was Elon Musk who might have said this, the more you're paying in taxes, the more money you're making. And so some people think, well, ooh, I'm in a new tax bracket, I'm going to make less money. No, because when you go into a new tax bracket, yeah, your tax rate goes up, but only for the money that is in that new tax bracket. The money below that tax bracket is taxed the same. So ending up having to pay more taxes is a sign that you're being successful and that your income is probably good. However, there are some legal, legitimate, perfectly safe, fine ways to lower your self-employment tax. Talk to a tax person, but for example, the most common way is to do an S Corp election. That causes the IRS to see your business in a way that is different from a traditional LLC or a C Corp. You can then split your income into two parts, salary or wage that you have to pay the self-employment tax on, and then profits that are added and you can get a preferential tax rate on. That's the most popular way for business owners who are making $80,000 or $90,000 a year or more. But talk to your CPA or tax person about how to get the best results. Okay, this is a topic I love. What is a healthy profit margin? Please, please, please understand that profit is good, profit is necessary. See so many TikTok and YouTube videos about people complaining about profitable corporations and about stealing from people. I think that there is a small amount of truth to that. But the fact is for small businesses, profit is how owners get paid. Profit is good. Profit is necessary. Please, profit. I talked to somebody recently who they hired skilled workers to work for their business, and then they paid those workers 60% of the money they made. And I told this person, no, that's too much. You can't pay them that much because that means your profit is capped at 40%. That only works if you have a very low overhead business. And when your business starts to grow, your overhead is also going to grow, and you will not be able to survive on a 40% margin. And case in point, okay, Walmart is known for being aggressive at being efficient. They know how to cut costs and save money. They operate on a slim margin. Walmart's gross margin is 35%. And they can get by on only 35% margin because they got a whole warehouse full of PhDs looking for ways to cut costs and make things more efficient. You do not have a whole warehouse full of PhDs working for you. You cannot expect your small business to operate on a profit margin about the same as Walmart's. Walmart needs at least 35% margin. 40% is too slim for your business. You need more. And so typically, if you have skilled professionals working for you, your skilled professionals make 40%, and then the business keeps 60%. That works. If you have unskilled professionals, it's usually more like 30 or 25% because your business probably has more overhead related to managing, training, onboarding, and offboarding the unskilled workers. And so I want you to know that you need a healthy profit margin. Labor is important because labor is typically a huge part of businesses' expenses. However, my general rule of thumb is that a service business should have a gross margin of about 50% or of 55%, maybe a little bit higher. And then businesses that have high shrinkage. Shrinkage is when you lose products. So if you imagine an Italian restaurant, at the end of the day, they throw their noodles away. Imagine a sushi restaurant. You don't want that stuff overnight, right? If you don't sell all your sushi, it goes in the trash. And so restaurants have high shrinkage. If you've ever been to Home Depot, you go down the aisle where they have wood and sheetrock, there's always busted pieces. That goes in the trash. They have high shrinkage. So high shrinkage businesses need a 60 to 70% margin. And so typically what I like to see is businesses having a margins of somewhere between 50 to 70%. That's what a healthy profit margin is. Now that's gross profit. Your actual profit is going to be less than that. And so if you have a service business where you use skilled professionals and you give them 40% of what they make, then that means your gross margin is 60%. The owner's profit is probably going to be more like 15% at the end of the day. That's fine. That's normal. That is your net margin. We're not talking about that. You don't have a lot of control over that other than by decreasing your expenses. For the most part, though, we're going to talk about gross margin, 50 to 70%. If you can go higher, good for you, but that's what I would aim for. What percentage of revenue should payroll be? Excellent question. If you are a one-person business, it's going to be 70, 80% of revenue. If you are a small business, 10, 15 employees or less, it's probably going to be 50 to 60% of your total revenue. Once you start to grow beyond that, I would like to see that number come down below 50%. And this is like a balancing act, because you have different kinds of expenses. Payroll tends to be a huge expense for businesses. And so it is normal for that to be 40, 50, 60% of the business. There are a couple different ways that you can bring payroll down as a percentage of your total outflow, your total expenses. One way is to increase other expenses. That's not really a good answer, though. You can't say, well, I'm going to pay more on software. I'm going to pay more on rent. I'm going to pay more on advertising. There's good reasons to do that, but don't do it just to lower your payroll as a percentage. I do like to see business owners reduce expenses. It's very common for business owners to spend a lot of money that they don't need to spend during the startup phase. If you're a restaurant, guess what? You're going to have to spend $1 million before you can even open your doors. That's the way it is. If you're a service business, let's spend a lot less than that. Let's challenge ourselves. What's the lowest amount of money that you can spend? If you've been to my office here in Johnston, Iowa, you know that it's not a very fancy office. That's fine. Most of my clients are virtual, and I like to keep costs low. That means I pay cash for things. I went and bought desks so that we can increase our staff. Pay cash for that kind of stuff. I ordered a sign to go out on the front of the building. I'm paying cash for that. I'm working on keeping expenses low. There's not a lot of artwork in my office yet. Maybe there will be, because I want to keep my expenses low. This is something that I would like you to steal from me. Keep your expenses low. If you're running a service business, do you need a trailer or can you rent one? That's a tough one. You might need a trailer. Do you need a skid steer or can you rent one? No, go rent it, unless you can find a ridiculously cheap deal at auction. But anyways, keep your expenses low. The one exception is marketing. And I see people spend too much money on marketing that doesn't work. So don't spend money on marketing unless you can track its effectiveness. But if you can track its effectiveness and you can tell, okay, every time I spend another dollar here, I get more money there, then don't hold back. That is good marketing. Spend money on that. All right. So what percentage of revenue should my payroll be? Brand new, single owner, single person businesses, 70%. Small businesses, 55% or less. Bigger businesses, under 50%. How much should employees be paid? This is a great question to ask. First of all, you probably need to pay a competitive rate. And when I say probably, that sounds like a funny answer. You do not have to pay a competitive rate if you can offer them something better than money. And believe it or not, there are a lot of people who would love to work for a company that has a mission or purpose that aligns with their goals. And I found that when I hire people, if they're not aligned with my goals, they're not going to like this job. It's not because of the pay, but you want to find people who are aligned with your company goals if you can. If you can find people like that, you might be able to get better people than your pay might normally attract. So first of all, you want to be competitive, but you might be able to get by with less if you offer a mission or purpose that makes them happy. But that said, if you offer them too little and they can't afford to live off of the pay that they are getting from you, then they're going to leave and go find somebody. Employee turnover is very expensive to businesses, so be careful. But if you've got a skilled professional and they drive revenue to your business, it's normal for them to make a third to 40% of the revenue that they generate. For example, if you have a consultant that works for you and you bill that consultant at $50 an hour, I'm sorry, at $150 an hour, then it's pretty normal that they're going to make 50 or maybe a little bit more than $50 an hour from the revenue that they generate. That could be split into two parts. They could get a base pay plus a commission. In that case, their pay is safe. That means that they've got a guaranteed pay. So people who choose safety, like a fixed pay, they're taking less risk and they're going to be closer to the lower end of the pay scale. Whereas if they are pure commission, then they're going to get paid more because they're going to be taking the chance that their pay is going up and down over time. And so employees who are on a pure commission basis typically make a higher percentage of their billable rate of what they're producing for the company, whereas companies who get a salary plus commission typically get a safer pay scale and then a lower total rate. So that's what I would suggest is 33 to 40% of the revenue that employees generate, but still keep in mind that you need to be competitive or you're going to have high turnover, which is very expensive. That's the last question. If you would like to see more AMAs, hit the subscribe button or the like button or the follow button. If you have questions, please let me know. I would love to answer them in the future AMAs that we do. Please watch for our upcoming webinar on 1099 versus W-2 contractors and how the laws have changed that plan. Otherwise, I will see you later.